Here's something that should catch every trader's attention today, Monday the 27th of July 2026. The Federal Reserve isn't just pausing, according to UOB, it's now facing a real chance of hiking rates again. For months the narrative was simple, rates were high, inflation was cooling, and cuts were just a matter of timing. UOB has just flipped that script. In a note published today, the Singapore-based bank says the Fed's current hold is an extended pause rather than a pivot to cuts, and crucially, the risk of another hike is climbing. That's a meaningful shift in tone from where markets stood only weeks ago, and it changes how every rate-sensitive asset should be read from here. So what's actually changed? UOB's economists point to sticky underlying inflation pressures and a labor market that keeps refusing to crack, both of which give the Fed less room to ease. This view, reported today by FX Street and echoed by Bitcoin World, marks a notable hardening compared with the market's earlier assumption of an imminent rate cut cycle. It follows a similar warning back in mid-May, when the dollar posted its largest weekly gain in 2 months as traders began pricing in higher hike odds. UOB's Monday note effectively confirms that trend has continued, not faded, through the summer, and it's forcing analysts to rewrite their rate cut timelines. This shift is already rippling through currency and commodity markets. The US dollar has been finding fresh support on rising hike bets, while riskier and rate-sensitive assets are having to recalibrate quickly. Interestingly, not every market is moving in the direction you'd expect. The Australian dollar has actually gained ground, helped by a hawkish Reserve Bank of Australia stance and easing Middle East tensions following US-Iran de-escalation. Silver has surged too, rallying close to $60 an ounce as that same geopolitical calm boosts risk appetite. So traders are juggling two forces at once today, a more hawkish Fed narrative on one side, and a friendlier global risk backdrop on the other. Looking ahead, UOB Asset Management strikes a broadly resilient tone, arguing the global economy can absorb these shocks, and it has even upgraded Chinese equities to overweight despite the uncertainty. But the core message for the coming weeks is clear: don't expect a straight line to rate cuts. Watch upcoming US inflation and jobs data closely, because any upside surprise could push the Fed from talk of a hike risk to an actual move. Currency traders, in particular, should expect continued dollar volatility as the market repeats this tug-of-war between pause and hike scenarios through the rest of the summer, with each new data release capable of swinging expectations sharply. The takeaway is simple: the era of assuming the Fed's next move is automatically a cut is over, at least for now. UOB's warning that hike risk is rising deserves your attention, whether you trade Forex, hold dollar exposure, or just want to understand where global interest rates are heading next. Keep watching this space closely, because the next Fed signal, and the next inflation print, could move markets fast, and being early to that shift matters far more than being right after the fact.